how do you help lower income people get money? Well, lending is the only really way to do that without charity. And to do lending, you need these different pieces of information in place. In many emerging markets and many emerging economies, credit scoring has been a challenge. There were so many companies that came out in the US and Europe, of course, emerging markets, and they were all like, well, we're going to use your social media profile to figure out your credit score. And the more that I've seen the successful companies emerge, the ones who kind of stood the test of time, even as interest rates go up or down, currencies change, it's companies that have understood their customers really well and built algorithm profiles around the behavior of their customers inside their own app, like with the things they do inside that product, not the things they do elsewhere. I'd say it's uncommon that there's no credit bureau in a country. There's always somebody who started something. Sometimes there's two or three, but this phenomenon of thin file, is a very common thing. So you'll have a country where there is a credit reference bureau, but they have records on maybe 3 million people in a country of 30 million people, or they've got, maybe they've even got 20 million records, but half those records don't really have a complete file. Maybe they only include a handful of negative events. They don't have any positive data. So these things all make it really challenging. Obviously, lenders then look for other signals. What are the other signals you can do to reduce risk or fraud? KYC is one of them, whether that's just verifying an ID number or a name or a phone number or a document or a face. And of course, the more things that you verify, the more costs you add, the more level of assurance you have. And to do lending, you need these different pieces of information in place. And I ran into this issue of realizing, as the more people I talk to, especially who are in the lending business, how much time and energy and effort they spent trying to solve the KYC issue, rolling their own solutions or using Facebook as a proxy. The credit infrastructure problem is multifaceted. Credit scoring and credit data is certainly part of it. The KYC is like an underlying foundational piece. But our hope with our business is that we can lay down that one foundational piece, and then there's other things that can be built on top of that. And I think in particular, a lot of the companies we work with who are in lending are building their own credit scoring models and methodologies, which have proprietary value for them, which is great. We hope that we can provide them sort of a basic level of KYC upon which they can build. The problem is you can build all the algorithms you want, but if they're built on top of a SIM card identity, and the person swaps the SIM or gets a new phone, it's like a house of cards. It all just falls apart. So having a foundational identity upon which you can then build these credit profiles or behavioral profiles or whatever is it's essential building block. I get a lot of this question of why do I have to sign up twice, or why do I have to do KYC all these times? And the perfect world would be one where you control your own identity credentials and you can sort of selectively permission them with different companies that you want access to services, and you can revoke those permissions. And even the laws that were created with GDPR were all kind of created with this utopia in mind. The reality of the problem is that if my customers want me to build something where I can share the identity information around, that means that I have to store all that identity information, right? And so that means then that I have to have a relationship with that customer about I'm storing that information, how long I'm storing it. The way we operate is we primarily do that through our customers. So they, whether it's, the Carbon or another bank out there that has a relationship with an individual consumer, that relationship defines the scope of the data sharing. And so, increasingly we're getting these requests from within our customer base. So hey, a bunch of your customers have already onboarded these users for a payment solution. Can we benefit off of that? And so we've explored the idea of being able to have our customers share data with each other and being a facilitator of that. And that gets a little easier because then we're doing something where all the parties involved know what's going on. There could be some basic kind of foundational policy that government can put in place. The U.S. went through this whole journey years and years ago, but where they sort of put in the rules where a consumer can request a free credit score at least once a year. They made it really simple. The data had to be shared in a certain way. And so part of the idea is you want to incentivize people to think about and be aware of their credit score, and then you want it to be easy for them to go to a certain place to get it, not to get it sort of needlessly and carelessly, which adds cost to the system, but to have at least some foundational idea of what a credit score is and where they can find it and why it's important. And so government can do a little bit of education on that and standards setting on that front, and then private industry can fill in the rest.